Today, we will talk about depositories. A depository can refer to a facility for storage or an institution that accepts currency or securities deposits from customers. Deposits placed in a depository must be returned in the same condition upon request. Depositories provide security and liquidity in the market by using the deposited money for safekeeping to lend to others, investing in other securities, and providing a funds transfer system. Depositories are buildings, offices, and warehouses that allow consumers and businesses to deposit money, securities, and other valuable assets for safekeeping. They serve multiple purposes, including eliminating the risks of holding physical assets, offering time deposit and demand deposit accounts, and accepting securities in electronic or paper form. Depository organizations also help create liquidity in the market by accepting customers' money, paying interest on their deposits, and lending it to others in the form of mortgage or business loans. Euroclear is a clearinghouse that acts as a central securities depository for clients who trade on European exchanges. Euroclear settles domestic and international securities transactions, covering bonds, equities, derivatives, and investment funds from over 40 markets. They accept a broad range of internationally traded debt instruments and equities, including domestic and international bonds from major markets worldwide. Depositories help reduce paperwork and speed up the transfer process of securities ownership. They also eliminate the risk of holding securities in physical form, protecting against theft, loss, fraud, damage, or delayed deliveries. Additionally, depositories play a crucial role in facilitating the delivery and storage of physical precious metals for investors and hedgers. Credit unions, savings institutions, and commercial banks are the three main types of depository institutions. They primarily rely on customer deposits for funding and offer various financial services such as savings accounts, consumer and commercial loans, and investment products. These institutions are insured by the Federal Deposit Insurance Corporation. A depository is a place for depositing assets such as cash or securities, while a repository is a central location for housing abstract items like knowledge or data. Depository institutions include banks, credit unions, and savings and loan associations, whereas repositories like software repositories and financial information repositories house abstract items. A depository institution is a financial institution that relies on customer deposits as its main source of funds. Examples include commercial banks, credit unions, and savings and loan associations. A non-depository institution is a type of financial institution that does not primarily rely on customer deposits. Instead, it acts as a third party to financial transactions. An example is a life insurance company, which accepts payment for insurance products but does not typically hold funds for safekeeping like a depository does. Depository institutions provide safekeeping for assets, pay interest on deposits, and create liquidity by lending out money. They also eliminate the risk of theft and loss of deposited assets. A depository is a place for assets such as cash or securities. Depository institutions include banks, credit unions, and savings and loans institutions, and typically pay interest on deposits. The Federal Deposit Insurance Corporation guarantees deposits at participating institutions, up to certain limits. Here are two key takeaways. 1. A depository can be for storage or an institution that accepts currency or securities deposits from customers. 2. Depositories provide security, liquidity, and a means of transferring funds. Hope this would help. Thanks for watching.